Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And in today's video, I want to talk about a couple ways that we can reduce our margin requirements on trades. And so this is a really good video, not only for people who have larger accounts, but if you're trading an IRA account and you want to mimic some of the undefined risk trades that we do here, or that anybody does, basically your straddles and strangles and ratio spreads, it's going to be hard to do that because those trades usually require a lot of cash up front for your IRA or your retirement account. And so in this video, we're going to talk about some simple ways that you can reduce or cut your margin requirements and also increase your return. So again, with larger accounts, you'll definitely want to trade slightly more undefined risk trades. These generally give us the biggest P&L dollar-wise at the end of the year, but of course they tie up a lot of capital and margin. So today we'll talk about reducing those margin exposures on selected strategies. This helps not only reduce overall risk in the portfolio, but also increases return on capital, which can dramatically help with our overall profit and, again, basically use of funds. So let's first start with a short straddle directly over the market for SPY. So I took this data as of today's date, the time that I'm doing this video, and you can see hopefully here, that the S&P is trading at about 205. So this actually works out pretty good. The straddle that's right over the market about a month out, which is about 2 months out, which is about 53 days, March. The 205 straddle, so we're selling the call and the put, takes in a total credit of around $925. Okay, so it's a pretty healthy premium right now, and implied volatility is pretty decent in these options. Now, when you look at the total profit here, which again is 925, versus the buying power or margin effect. So this is what a broker would typically charge you to get into this trade if you just have undefined risk spread or undefined risk on both sides. So notice we didn't buy any options, we're naked 2 options directly over the market, 1 call and 1 put. So in this case, our broker is going to require that our initial margin is about $4,098. So you can see the amount of credit that we take in of 925 divided by our margin requirement means that we should make about 22.5% return on our capital if everything stays the same and our options expire completely worthless out of the money, okay? And you can see there's probably a fairly high probability of success trade because our break-even points based on the credit that we receive are almost $10 out on either end. So you can see our break-even point on the lower side is 195.75, on the top side is 214.25. Again, we just take the strike price of the straddle and we add or subtract the credit that we receive to get the break even on either side. So what we're going to do now is take the same straddle, so those same short strikes, but now we're going to buy the wings or further out options about 25 points out on each side to reduce margin required and increase our return on capital used. So here's what we did. Again, the stock trading about the same price. It was just live market now, so we got this data. The stock's down a couple cents. But you can see that now we're doing the 205 straddle, which we're selling the 205 calls and the 205 puts. And instead, what we're going to do is we're going to add the 230 puts that are going to be long. So we're going to buy one of the 230 puts, and we're also going to buy one of the 230 calls. And we're also going to buy one of the 180 puts. So we're going to buy the wings of this strategy and basically create a very wide iron condor that looks like a straddle over the middle. It's basically an iron butterfly. We have the short strikes exactly the same as what they were, but now we're buying those wings 25 points out to reduce the margin required on the trade. Now, because we had to pay a little bit of money to reduce some of that margin, you can see that our credit has been knocked down to about $850, so about $850. So our max potential profit on this trade is $850. Now, because we don't have any more risk beyond those points at which we bought the options, so 230 and 180, we don't have any more risk there. The broker doesn't have to cover any of that risk. Our buying power is reduced to 1,655. So that means that our 850 credit divided by 1655, which is the new margin required for the trade, gives us a return on our capital of 51.35%. Now, you'll also notice that the break-even points for this trade have also reduced just a little bit on either side because that credit is a little bit smaller. It's 850 now. Our break-even points have come in to 196.5 and 213.50. So as you can see, we were able to cut our margin required by nearly 60%. And when we did that, we only were giving up about 9% off of the initial credit that we received on the short straddle. This spread helped more than double our total return on capital. Now again, the only downside to doing this is that our break-even points are now narrowed based on the reduced credit, which means that our long-term win rate is going to be slightly lower because the stock can move just a little bit outside of that range. It's not that much, it's about 1 point, but the stock can move outside of that range and again reduce our long-term win rate. Again, it's all about the numbers. So still, even we feel that reducing our margin required and increasing our return on investment per trade for a slightly less favorable win rate long term is a very good trade-off. Again, we reduced our margin by 60%, and in doing so, we didn't reduce our credit by 60%. We only reduced it by 9%. So it's a great trade and a great way to reduce capital required on a trade. The same thought process, of course, and logistics can be applied to similar undefined or naked trades like strangles and our custom orders that we talk about and ratio spreads. So make sure that you go in there and play around with the numbers, use the Analyze tab in your broker platform, and see what works for different securities. It won't work exactly the same for every security, but the same thought process should go into place with all of the trades that you make. And again, this is a great strategy for retirement accounts and with IRAs because in those accounts you can't trade undefined risk trades, and all of these situations that we just went through here with this iron butterfly kind of adding those wings, that's a defined risk trade, and you will be able to do that in your broker account or your IRA account. So as always, I hope you guys really enjoy these videos. If you have any comments or questions, please add them below in the show notes, and until next time, happy trading.